Welcome to video number 5 in Trade Life Cycle. We'll explore the role of mid-office in an investment bank. Many of us are aspiring investment bankers seeking jobs in large investment banks like Goldman Sachs, JP Morgan, SocGen, etc. So let's understand what is the role of the mid-office in an investment bank. Most often, mid-office is concerned with risk and compliance. So let's see what is risk and compliance. Mid-office is a risk and control function. What do we mean by risk and control? Risk and control means putting into place this framework within which the organization must work, the dealer limits, the market limits, and also putting in place whether the dealers are complying with the rules and regulations of the organization. The two major steps of the trade life cycle in the mid-office that is conducted by the mid-office is validating the trade and booking the trade. Let's understand now what is the meaning of trade validation and then trade booking as well, because these two steps are critical in terms of risk and compliance. So let's understand what is trade validation. As the English term validation means to find out whether everything complies with the set rules. For example, is the counterparty recognized by the trading system? Is the dealer taking up a trade with a recognized counterparty? This is a very important question to be answered, otherwise it exposes the bank to unnecessary credit risk. So therefore, all the documents with reference to the counterparty have to be in place. The second part is the deal within the counterparty limits? For example, bank A takes a trade with bank B, but they're not allowed to trade more than $10 million, and a dealer goes ahead and places a deal worth $15 million. So this is beyond the counterparty limits, and this unnecessarily exposes the bank to counterparty risk. Are the legal documents in place? This is very important, especially with respect to OTC derivatives or over-the-counter derivatives, because legal agreements like ISDA agreements have to be in place before entering into the contract. Is the trade an authorized trade? If the trade is not authorized, then the bank is exposed to market risk, which results into the fact that price fluctuations on that particular asset may cause losses to the bank. So authorized trades only should be permitted by the banking system. Are all the trade details correct? For example, is the settlement date a working day? Is the trade date within the working hours of the markets, and so on and so forth. So risk and compliance largely concerns itself with a whole lot of questions that I've already spoken about just now to explain how the bank can reduce risk. After the trade is validated, the trade can then be booked in the books of the organization. The trade is booked after all the trades are validated by the mid-office. This booking of the trade means there's an acknowledgement in the systems of the bank that this trade has occurred before proceeding towards clearing and settlement. So if there's any confusion at this point of time, the trade should not be proceeded further. Otherwise, it could result into some kind of monetary losses as well as penalties that could be imposed. Thus, in some investment banks, trade confirmations are also conducted by middle office. In some investment banks, they're done by back office. If it is done by middle office, then trade confirmations are an integral part of risk and compliance function. Confirmations are needed from counterparties so that the bank is not exposed to risk on account of counterparty failures. Confirmations are critical for mitigating the settlement risk. The settlement risk is the risk that one of the counterparties to the trade has performed his part of the trade obligations, but the counterparty has not performed. This is called as Hurstad risk in banking terminology. So let us now see what is the example of how confirmations are useful for mitigating this settlement risk. Settlement risk exposes the bank to penalties. For example, a failure to send confirmations is a case of operational risk. This means that the bank is now no longer able to get any settlement of the transaction. What happens if the dealer, on the basis of this, has already taken a reverse position? Then the bank is exposed to losses on both legs of the trade. Another example is if there's a failure to receive the confirmations, this exposes the bank to credit risk. So failure to send confirmations is operational risk. Failure to receive confirmation exposes the bank to credit risk and sometimes even market risk. What happens if the trading position is long and the prices start collapsing? Thank you so much for watching this video. If you like the contents, do subscribe to my channel and looking forward to your comments.